The vision is to connect all things cryptocurrency, commercial real estate, traditional investing, using what's called the Deferred Sales Trust. This is how you can hold off paying capital gains tax on the sale of your Bitcoin profits or other cryptocurrency.
You know, at the end of the day, we just try to make things easy and simple for people. We take the complexity of taxes, complexity of investments, and we try to work with other professionals in a very high level, very professional, collaborative way. We don't need to be arguing or stepping on toes or trying to prove that one method is better than another method. Let's look at everything. Let's put it all out there and let's make sure that all the clients' advisors are all on the same page.
It'll be interesting to see how it plays out and to see how you guys develop your mechanical processes to deal with people that are across different exchanges that don't just have Kraken. They're going to be multiple exchanges, and probably something you guys want to address early and be early in that space as well, so you're prepared for people that have that issue.
Just in case, we set up a personal business of mine, a crypto business of mine, and within that business, I could hold all those wallets, right?
It says, for generations, people believed it was impossible to run the mile in under 4 minutes. They believed the human body wasn't capable of going that fast and that it would collapse under the pressure. Some doctors and scientists said it wasn't just hard or dangerous, but physically impossible. No one could run a mile in under 4 minutes. The announcement was drowned out by the crowd when they realized it was under 4 minutes. Bannister had finished the race in 3 minutes, 59 seconds. He had done what so many people believed was impossible. He broke the 4-minute mile. It says after that record was broken, it was held up for only 46 days before it was broken by John Landy. Once people saw it was possible, it created belief in others that they could do it too. So what I love about this story is that for decades, maybe hundreds of years, maybe thousands of years, no one believed that the 4-minute mile could be broken. And then it was broken, and then within 45 days, literally another handful of men broke it, and now 1,400 more people have broken it since 1954. So I believe that is where we're at with this cryptocurrency current marketplace. We closed the first one, $5 million of Bitcoin, Ethereum, a mixture mostly Ethereum. And now we're getting a wave of individuals who are finding us. You might be finding us right now.
I'll tell you, you made me a believer when we got the wire from our mutual client who made this work. And it was a real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty what do you call it? Hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked.
We've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. And I still don't think I'm an expert. Not that it's that complicated, but its power is to a degree in its flexibility. And so it's sort of like every time I'm like, that's slightly different. That's a different setting, different context, different opportunity, different challenges.
Being honest and admittedly, I know nothing about Bitcoin or any of this, so this is all like very, very new to me, and I'm here to learn a lot of different aspects about the trust and DST, and it's interesting conversation that I might not be having right now with a lot of my clients, but I feel like in the future it will be. So I'm just trying to absorb it and listen, but if I look confused, that's why.
If you have any questions at all, you can go to capitalgainstaxsolutions.com and you can schedule a one-on-one consultation with me or one of my team members, and we can go through this. Remember, our minimum is $1 million net proceeds, $1 million gain, unless you have two properties, cryptocurrency worth 500 and something else worth 500 to combine together. But I hopefully you feel encouraged today and more confident about the Deferred Sales Trust.
Hey, Brett, let's take you off mute real fast.
Hey, welcome everybody. My name is Brett Swarts, founder of Capital Gains Tax Solutions. So excited to have everybody here today for another mastermind. We're calling this DST University. We're calling this the Crypto DST Tax Deferral Strategy Session, where everyone's invited, whether you're new to the Deferred Sales Trust, new to selling cryptocurrency, new to selling businesses or real estate, and trying to find a way to escape feeling trapped by capital gains taxes. I'm with my good friend and business partner, Jake Muller, who's also a co-host, financial advisor. He trains CPAs, he manages funds, he does so many other things, but really is specialized in helping our clients defer capital gains taxes. Jake, how you doing?
Doing very well. Yes, it's a wonderful day from Mexico.
Mexico, okay, so very nice. What part of Mexico? Because that's a big.
It's a big country, right? Yeah, exactly. So here on the west side, so same kind of. You're in California. Just keep on going down through the Baja and then inland to Mazatlan.
Excellent, very nice. I know you invited me there, and one day I plan to get there. I've been to Puerto Vallarta, which I believe is just a couple hours south.
Correct, just another 5 hours south in a car.
Okay. Yeah. Excellent. We've got our other he's kind of a co-host, Pierce York, out of the Newport Beach. Pierce, what is going on? Some big news this week. What happened, man? What's happening?
We had a baby. So that's been fun.
That's wonderful.
A baby.
Yeah. So we're settling back down, trying to get everything, kind of back into a new routine, new normal.
So we need some details, Pierce. You need to announce to the world. Name, weight, experience.
Yeah, her smoothest pregnancy delivery. I mean, that I've encountered. This is my third one. So, baby water popped at 6 a.m. after a good night's sleep. We got to the hospital around 8. She had one med to help kind of like speed the process up. We delivered by 4. Smooth, healthy, beautiful baby girl. Her name is Bella Love, and she is 7 pounds, 12 ounces, 20 inches long, healthy. And now it's just trying to get mama to recover and me to try to figure out how to go from man-to-man to zone defense. So that's where we're at.
Congratulations, Pierce.
Thank you.
Very happy for you.
Yeah.
So, Jake, you wanted to give our listeners and our new attenders a little bit more about the vision for what we're trying to accomplish here in the next 30 to 40 minutes here.
Absolutely. In layman's terms, the vision of what we do is we help people with highly appreciated capital assets find solutions and ways by which they can reinvest the proceeds from the sale of those capital or highly appreciated assets into other investments. Let it be crypto, let it be real estate, let it be stocks or other rights, such as stock options, things of that nature. We can help those individuals process those transactions and reinvest it in other assets without it becoming a taxable event to them. And we do that with the Deferred Sales Trust.
Beautiful. And then, so that's the vision. We're going to cover like the deal close story of the week. And then we're going to open it up for questions. And if you have questions along the way, feel free to put that into the chat and or unmute yourself and just jump right in. And so let's move to the deal close story of the week. And this one is actually happening right now, or it happened yesterday, and the funds are all hitting today. And it's for a couple who is selling a dental practice. And they're selling this dental practice on the East Coast in the New Jersey, state of New Jersey. Owned the practice and ran the practice for over 20 years. Zero basis, highly appreciated, multi-million-dollar sale. And also, as you know, New Jersey, New York, California, these states are very tax heavy. And instead of paying the capital gains tax, they just said, hey, you know what? If we can defer it and we can live off of the interest payments over time, we would like to do that. It made sense mathematically, and also made sense they didn't need all or want all of the funds all at once and be taxed in a heavy state. They also might consider moving out of New Jersey and establishing residency in another state, which can also lower the tax burden as they receive payments back from the trust. By the way, I made a couple videos this week. In fact, they dropped this morning on designing your deferred sales trust note, which kind of breaks down the nuances of how you can design it and some ways that you can take advantage of relocating in different states. And the second one was all about selling multiple assets into one single trust. And so you can go to, again, capitalgainstaxsolution.com or search that on YouTube to learn more about those short videos there. But what's unique about this deal was the husband, he was the practitioner. He was the doctor, right? He was the dentist practicing for many, many, many years. His wife was more of the business, the operation side, the investment side. And so combining those two minds to understand what this thing is, have them get comfortable with it. Their reservations or their challenges were like, 95% of all the folks that come to us, which were, hey, I've never heard of it. CPA, never heard of it, doesn't know. How do we know it's legal? How do we know the funds are protected? Where can we invest? What will be taxed as we receive it? Can we really pass this on to our kids long term? Yes. Can we go back into businesses if we wanted to? Now they're older and they're not looking to necessarily do that per se right now. They might go into some real estate, but mostly this is going to be in securities and liquid investment grade securities for the time being until they see or want a deal that makes some sense to them. They've been so focused in the practice, right, that they haven't really focused on the exit until really the last minute. They met us, I think 60 days ago, right? And then it just closed. So that's kind of the debrief there. Jake, anything that sticks out or any questions or thoughts you want to bring to the table there?
It's kind of important to realize that this type of transaction, it can really happen anywhere in the United States. I mean, this trust is a trust that goes along with the United States IRS code, but in line with what these clients are doing, we even have another client that has assets being received from outside of the country, but they would be taxable to him here. And so when it comes to a transaction that would be taxable here in the United States, this is definitely a tool that can defer those taxes going forward and allow you to reinvest the entire proceeds net of attorney fees rather than net of taxes, which is a substantial difference. And that's just kind of the magical thing of how this works. Oh, you're muted, Brett. Kind of click the button.
Sorry again, guys. Pierce, how about you? Any thoughts on that? Or even Rebecca, or even Andrew? And I see Andrew joined us. Welcome, Andrew, on that transaction, or questions or thoughts.
I think it's just amazing you can do it with a business. Like it's a dental practice instead of, this is great. This just opens up so many more possibilities.
I have a question. You mentioned they're a little bit older, so that makes me think about stepped up basis. And of course, if you 1031 and you, swap till you drop, right? Do you get a stepped up basis when your funds go into a deferred sales trust like you would, like when they're sort of unsheltered and just like in your own name?
That is the one advantage for sure that Blockbuster 1031 has over the Netflix Deferred Sales Trust, is that it maintains the stepped up basis. Now, in their scenario, they're practicing full time in their business, right? And so it's like they want to work till they're 90 or 100 years old versus getting that stepped up basis. The answer is no. They want to enjoy their wealth and retire. However, their kids can step into their shoes, meaning that the promissory note can pass inside of the living trust, which they have set up, and their kids step into their shoes and can maintain the tax deferral. So the tax is not triggered upon death. It's just the kids, if they're going to take the tax, if they're going to take the payments, they'll pay tax. If they're going to dip into principal, they'll pay tax. But you're right. The stepped up basis is one of the most amazing tax strategies for the 1031 exchange or any other assets at this point, right? That upon death, the kids can step the property or the asset bounces up or increases to the current market value, which means if they were to sell, they would have no tax. But the deferred sales trust, if they were to liquidate, they would pay tax. That makes sense, Andrew?
Yeah, so just to make sure I understand with numbers, right? Let's say they sell the practice for $3 million and the basis is zero. If they 1031 it into a triple net lease and then they die the next day, then their children or their estate inherits the whatever they buy with the 1031 at the purchase price, not the purchase price, the market price. But if they deferred sales trust it, when the estate receives it, the basis is essentially the zero. It doesn't go up to the market value at the time that the people decease, correct?
Correct. Except the only difference here is the business cannot 1031, right?
Right. Okay.
Cryptocurrency,
Right.
Cryptocurrency can't 1031.
Right. So they had no option but to DST unless they were just going to pay it at that time.
Yeah, and if we had to rank like which asset owners can benefit the most out of everybody, we would say crypto, Bitcoin, Ethereum. If you're in any cryptocurrency, we think it's the number one, and there's a couple reasons for that. Number one, there's no 1031 option.
Right.
Okay, right. Whereas investment real estate, you have the 1031 option. Number two, you see really high highs and some low lows, right? Whereas real estate, it takes some time to get those highs and those lows, right? It's kind of a slow moving Titanic.
Right. Slow burn. Yep.
Where you have some fast moves with crypto. So we believe this is why the deferred sales trust was created for the cryptocurrency owner, because we know when it's a good time to sell, which is like right now, right? Or at least take some chips off the table. I mean, that's what happened with 3 of our clients, or 2 of our clients, but 3 deferred sales trust Bitcoin Ethereum deals, and that they just dollar cost averaged out, right? One had 50,000, went to 50 million. They took 5 million to start. And then on January 1st, they plan on taking another 1.3 million. That was for Jake Miller and I client who is starting a business right now with the funds, all tax deferred. And that's great. And then didn't have to take all of it all at once. And then likewise, another client, same thing, bought Ethereum and Bitcoin. It went from like 30,000 to 13 million. Same thing. They sold about 5 million. And then that was about 60 days ago. Then they did another 2.5 million. So you can slowly get out, defer the tax, and spread it over time, which is really nice. So that's number one. Cryptocurrency owners, I think, are top. Then you can put it into real estate, securities. You could put it into a business venture. Number 2 would be business owners, because business owners do not have the 1031. Okay, it works for LPs, LLCs, S corps, C corps. Okay, partnerships. Versus the 1031, the whole entity must move, right? Which also puts the investment real estate owner at number 3, if you will. I feel like business and crypto are like both number 1, and then like number 2 would be like investment real estate owner, because at least they had the 1031. At least you have a shot to go find a deal that makes sense to you, right? That makes sense on a cash flow, that makes sense on on just a purchase itself. Jake, any thoughts on that?
Ideally, this allows people to do more than they were able to do previously. And when I say do more, be able to diversify. And it kind of in line with what you're saying, Brett, some of our other clients that have been super heavy, strong in crypto, or that's where they made all their money. And it really doesn't matter where you made all your money. Perhaps it's time to divest and to use what was your cash cow that provided you with everything that you have, and then build other assets. A lot of times I give these presentations and seminars to these accountants from across the country, and we talk about creating outside assets. So you've got your business, your focus, you're a business owner, you're an entrepreneur, you're a serial entrepreneur, whatever you are. And for whatever reason, you have some wealth in the moment. So that you don't lose it all, perhaps because government regulation or things just might change that completely alter what brings you wealth today. Use what you have today to diversify. Build outside assets. Go buy that duplex. Go buy that multifamily. Go buy, sell out of crypto when it's high and when it goes back down, because as we mentioned, things are cyclical. It's moving, it's fluctuating. Reinvest when it's low, but then use some of those gains and go buy something else. The deferred sales trust. So this is just common, ordinary. There's nothing rocket science about this. This is just typical advice that is given to business owners, right? And to their CPAs. And a lot of times their CPAs are giving it to the business owners. And the deferred sales trust helps people accomplish that with more money, because they don't have to incur the transaction and do a 1031 into something of like kind where it's all moved over. They don't have to do the transaction and lose 30%, 20%, 50% of the transaction based on how it's being taxed. They get to roll over the entire thing into multiple other assets. You have choices and decisions, and you gain an executive team. And that's something that sometimes we forget to tell people about, Brett, is the benefit of the advice of other investors, namely Brett and myself. We invest ourselves and we help other people make prudent investments at the same time. We align them with individuals like Andrew and others and peers so that they can find that right investment to roll into. And we have connections and contacts all over the country and out of the country. So all of these things are for the benefit of the individual and their ability to continually reinvest as the serial entrepreneur that most people want to be.
Beautiful, Jake. Fantastic. Now I'm going to open it up for questions from anyone in the whole audience. I'm going to start. We've got Rebecca, we've got Scott, we got Carrie, we got Cody, we got Gabriel. Of course, Andrew too. Great questions. You can keep asking them. You can type them in the chat if you're not ready to reveal yourself via the Zoom on this call. But you can also unmute yourself and go on the video there, and we can see it. We also have Jim. In the meantime, we'll have Andrew ask the question, and then anyone else. We also have Charlie. But Andrew, you have any thoughts or questions on that?
Me? Right? Yeah, I got a question for you.
Sure.
You can, let's say someone is either unaware, let's say they're trying to do a 1031 and they're coming up on their 45-day window and they're like, shoot, I don't have anything, right? And if you fail the 45-day window, then the money still has to sit with a qualified intermediary for 180 days. So let's say it's day 30. I believe what I've read is that the Deferred Sales Trust can save a failed or failing 1031. So can it only do that first of all, is that true? If it's true, can it only do so in the 45-day window, or can it also do it in the 180-day window? And then the other part of the question is, how long does it take? Someone calls up, they're like, Brett, Jake, Pierce, I need to set up a DST. Can I do this in 5 days? Does it need 5 weeks? What's the timetable on it?
Great question. So
can I respond just real fast?
Go ahead, Jake. Yeah.
I would throw out that let's look at this scenario through the eyes of like the IRS. And, if your intent was to do a 1031 and then you couldn't because of various reasons, then your intent from the beginning wasn't really to do a deferred sales trust. Right? I mean, in the scenario that you presented, that's kind of what they would say. They would say, well, you're only doing this for tax reasons. And the deferred sales trust is like a business trust. It has to have a purpose. And in the situation you presented, it doesn't really have a continuing purpose. It just has a tax purpose, which isn't justifiable, so to speak. Some would argue that it's not justifiable. Again, I don't work for the IRS. I'm just, if I were in their shoes, that's how I would view that scenario and situation. Brett, do you want to comment?
No, that's a good point. And you are, and our clients that we work with, they are going for the 1031, and then they can save a failed 1031. We call it bifurcating the 1031, and essentially means that the funds are going to the trust instead of going directly to you. So the answer is yes. Can it save a failed 1031? Absolutely. I think we've done at least 7 or 8, 9, 10 this year alone. Okay. And so we're saving them all the time. Sometimes we're doing partial 1031s, by the way. Sometimes people have what's called a mortgage over basis challenge on the sale of an investment property. And the Deferred Sales Trust cannot defer any debt over basis. And so we're using what's called a partial Delaware Statutory Trust, known as I call it a Delaware 1031. And it has its places because we want to replace some debt. We have a whole another video series on the Delaware Statutory Trust versus the Deferred Sales Trust you can check out. But I think of this like on a Rubik's Cube, right? Where we got to line up all the colors and make it make sense for whatever problem you're trying to solve. So each particular client, and this kind of goes to Jake's point about the executive team, we want to be here to help you solve the problem. We always say we're not in the business of selling capital gains tax deferral deferred sales trust strategies. We're in here solving your problem. And when you bring your problem, we're going to try to take this a Rubik's Cube, and you're going to hand it to me probably first, and I'll put some of the colors together, right? Then I'll probably hand it to Jake Miller. He'll put some of the colors together. We hand it to their tax attorney, CPA, who are the brain surgeons, and they usually line everything up like really well. And then all of us together have this cube now for tax deferral, as long as we follow the lines and we don't shift it too much in a way that could cause tax deferral. We remain in this amazing place of optimal timing, opportunities to buy new properties when it makes sense, passive or active, dollar cost averaging, right? Moving funds outside the taxable estate. That's where all the things come together. But so to answer your question on the timing piece of it, there's really 3 windows to close on a deferred sales trust if you are selling an investment property. Window number 1 is at close of escrow. So in that scenario, we do need to set up the trust prior to the buyer removing all contingencies. Okay. Now we can set up trust in 24 hours, 48 hours, right? No one likes to move under those fire drills, but we do have people calling us, hey, my buyer is going to remove contingencies in another week or 2 or a couple days. Can we set up a trust? The answer is yes, we can do that. And we have done that. And we can insert language that the seller has the right or the option to be able to use this deferred sales trust or a 1031 exchange at no additional cost to the buyer. Boom, that's set. So then at close of escrow, the seller can assign all of the rights, exercise that option, and the funds go to the trust. So that's number 1. But number 2 would be the funds are at the qualified intermediary. Maybe you're in day 20 of your exchange right now. You're listening to this. You're like, I haven't even heard of the deferred sales trust. I thought it was a Delaware Statutory Trust. Oh my gosh, there's another opportunity here. And if you have identified something, people may or may not know this, but within your first 45 days of identification, you can identify and de-identify as many times as you want. The drop deadline for that is basically 5 p.m. or say on the date of 45th day of the close of your escrow, right? So up until that point, let's imagine you had set up the deferred sales trust. It's day 21. You're like, Brett, I'm not finding any deals. Great, let's set up the trust. We got it set up. And I say, have you identified anything? And Andrew's like, yeah, I have. I got these 3 properties I'm running with. Okay, well, Andrew, let me ask you this. If and when those deals don't work out, will you know before day 45? You're like, yeah, I should know probably by day 40. Okay, perfect. So I'll tell you what, on day 40, if it's not going to work out, I want you to let the exchange accommodator know I hereby de-identify these, okay? That opens up the window for us to close on the deferred sales trust basically on day 46, okay? Does that make sense so far, Andrew, on those first 2 windows?
Yep.
Okay, now let's talk about the third window. Third window would be, Andrew, you identified these 3 properties and you're like, when can you de-identify? You're like, I don't know. I might not know until like day 150. Okay. Then you push through your 45th day. When can we close on the deferred sales trust? The answer is day 180. Okay, day 180, right? So in other words, we have to allow the exchange, let's say the opportunity or the legality of the intent to fail. Okay, that's kind of the layman terms of saying this, right? And so it can't have any chance to actually succeed if we're going to use the deferred sales trust, which is in number 3. Andrew, any questions on those three windows?
I mean, if you can do it at day 180, then number 1 and number 2 are kind of underneath that because they're all prior to it.
Yeah,
right?
You don't owe anything unless you do the deal, by the way, too. So we work on a no cost, no obligation basis.
Yeah.
So the answer, exactly. So we always say, why would you go with any 1031 exchange company that A, that doesn't allow you to have the backup plan with the deferred sales trust, B, doesn't know what they're doing because they've never done it before,
right?
And C, puts yourself in a very high risky state.
Right.
You wouldn't.
There's only some qualified intermediaries that know of and are comfortable with coordinating and working with a deferred sales trust, right? Other ones are like, I don't know, I don't want to be touching that. They're sort of got.
You got it. There's only so many that want to accommodate,
right?
Right? And there's so many that even know it, and you can't blame them. They don't know it. I didn't know it at Marcus and Millichap when I thought we were the Navy SEALs of all investment real estate multifamily brokerage, 1031 exchanges until 2009. And then I learned the Netflix versus Blockbuster, and now I'll never go back. I will never, ever work with a qualified intermediary. It doesn't allow my clients to have both options. It's just there's too much risk. Like, why would you do it, right? So I never send any funds to any other qualified intermediary if they don't allow it. And I don't recommend anyone ever do that, and because there's no downside. The downside is you don't use the trust, you don't pay us, you do your 1031. We give you a high 5. So yeah, you want to make sure they offer the Delaware Statutory Trust. They have experience with that, the 1031 exchange, and the Deferred Sales Trust. So you have all of the options there. Now remember, we're talking about investment real estate right now, which qualifies for the 1031 and the Delaware and the Deferred Sales Trust with all this timing. If you're selling cryptocurrency or anything else, business, primary home, artwork, collectibles, private or public stock, carried interest, the deferred sales trust must be set up prior to the close of escrow, and even more so prior to if it's involving a buyer with doing some contingencies prior to them removing all contingencies. Okay. So if you call us and say, hey, I'm closing my business tomorrow, I remove, or in 2 days, and the buyer's removed all contingencies, we're just waiting for this thing to fund. We're going to say, sorry, it's too late. We can't do the deal. Does that make sense, Andrew? Any questions there?
Yeah, no, it's good. Thank you.
Yeah, and just going back to the qualified intermediaries, and goodness, somebody who doesn't provide you with both those options, it's almost like a mechanic that only uses standard and doesn't use metric tools. I mean, they can do it for some people, but they're not doing it for everybody, if that makes sense.
Yeah, and guess most of them don't want you to know about this, right? There's some folks out there that are very, let's say, anti-deferred sales trust. They're not even just like, hey, we'll compete. They're like, you know, they say it's not legal, it's this or that. You're like, well, we've been doing it for 25 years, thousands of closes, billions under management. And in fact, Biden's talking about taking your 1031 away. He's not talking about taking the deferred sales trust away. We're in a very good spot there. Jake, thoughts on that?
Yeah, I was just going to say that. I mean, it's not that there's really anything negative about it. It's just, it's disruptive to the way that they've done things in the past. And being disruptive, I mean, if they don't adjust their way of doing business, then they lose out, right? So when people don't understand something, or they do understand it, but don't want to adjust and change as times are changing and everything else, or, you know, something newer and better, and not necessarily newer, but new to them, so to speak, comes along, and they don't want to adjust their business model or their services that they offer, they don't want the client to know that there's a better way, so to speak. And that gives them fear, right? A fear that the client will find out that there's a better way, or that what they have doesn't fit every scenario, that it's not a one size shoe that fits all. Anyway,
Yeah,
just a few points to throw out there, that not everybody who perhaps is a professional, and trust me, I work with professionals every single day, all day long. We work very, very friendly with people. We don't step on any toes, but sometimes individuals, out of a feeling of like competition or something, they don't necessarily work well with others. And that's kind of the type of individual that would complain or say things negatively about the deferred sales trust, which, you know, it's just out of context, so to speak.
Yeah, very well said, Jake. And I actually have firsthand knowledge of that. When I first learned at Marcus & Millichap, my manager who brought in my business partner to speak on this, who's the co-founder of the Deferred Sales Trust, and he's taught me like everything I know. The first manager was like, come on in. It was 30 of us, and it was like a welcome party. And then that manager left Marcus & Millichap within like 2 years, and a new one came in, and he like calls me in his office, has like a serious sit down with me, and I'm like, what's he going to talk about? Like, he's like, I don't want you talking about the deferred sales trust. I'm like, why? I'm like, this helps solve the problem. He's like, we don't do that here. We do 1031s. I'm like, what do you mean? We've been doing this for 2 years, talking to people about it and helping people. He's like, nope, not under my leadership. And it's like, okay, so I can solve the problem and it can help all these people, but and part of it is because they're driven by transactions and they know what they know, like, and trust. And so that's all there. So Pierce, I think you had a question or a thought. Did you want to jump back in?
Yeah, just to I just kind of wanted to touch back on something that Jake said a little bit earlier, just about how the intent of the 1031 versus like utilizing it with the deferred sales trust, and just kind of pose the question, or thought, I guess, would be like, if the intent is to, reinvest the funds, right, in a deal that actually makes sense, does that change the perspective from, possibly from the IRS's standpoint? It's like, look, I can't find the deal that makes sense. And so that's why we're doing this, not just for tax purposes. So is it how you position it and how you kind of like articulate it that would make the IRS think differently about it? Or where did that come from?
Yeah, and so primarily the point was touching a little bit more on the timing and the documentation of how we're presenting it, right? People who do things at the 11th hour, it kind of like, wow, why this wasn't something that was planned beforehand type of a thing. And that's why we like those qualified intermediaries who present the two options, because then they can say that this was being considered from earlier on. When Brett and I are talking with individuals about the deferred sales trust, we have records of it being considered, even though in my firm, with a lot of my clients, we might talk about 5, 6, 7 different options. And we're annotating everything that's going on the entire time so that they can make a conscious, deliberate decision and move forward, oftentimes with a deferred sales trust if they are eligible. And if they're not eligible, then we choose something else. Or in the very few circumstances that something is better for them than the deferred sales trust because they have a very unique circumstance, then we adamantly recommend what is in their best interest as a fiduciary, right? But going back to your point, it's important that we have integrity of intent. Integrity of intent meaning our desire to reinvest it, and maybe we need the flexibility of time, or as you mentioned, flexibility of what we reinvested into. And that may or may not fit with a 1031, or that may or may not fit with other types of strategies, where it does fit with the deferred sales trust. And so ideally, if we're going to save a failed 1031, it looks better should you have these discussions, and if you should be implementing parts and pieces of the DST along the way.
Yeah, and also realize that this benefits the IRS, right? The IRS doesn't want people afraid to go trade deals or not sell cryptocurrency or not sell businesses because of the capital gains tax liability, right? They want to incentivize us, all of us, as highly appreciated owners of assets to sell, unlock the capital, and go redeploy it into investment real estate, businesses. As part of why it cannot be tax deferred into a primary home. It's used for the macroeconomic growth of the economy, which creates more jobs, which creates more tax revenue, right? So all of these things are good, and that's again also why you can get with this early, and you can get engagement agreements signed. You can get all of that intent that you might have questions on all up front. But that being said, we're going to move on to a few of these questions that we've been receiving in the chat. From Cody, we have, when receiving payments from a DST, is it considered taxed as income? Well, it depends, Cody, of when and how you receive the payments. So if you receive ordinary interest, or interest payments is taxed as ordinary income. So let's do an example. Let's say you sell $12 million of Bitcoin, and that is at an 8% payback to you, $800,000 a year. Let's say you're taking 400,000 of that 800 in year one. That 10 million is tax deferred, and that $800,000 of that 400 you receive, and another 400 goes into the trust on top of that. On that year one, you'd pay ordinary income tax. You get a 1099 INT, really simple. You just give that to your CPA and say, CPA, I received income from a promissory note. You'd also report the sale as well on a form that we work with your CPA to fill out, check a box that says, yep, I sold Bitcoin or Ethereum or whatever it was for 10 million. My basis was 100,000, and it's in a deferral state. And I'm deferring this until, and then as you dip into principal, let's say you took, instead of 800,000 of the interest that it earned, you did $1 million in that first year. So that 200,000 would dip into principal. That would you pay capital gains tax on that 200, but that other 800 that you received would be ordinary income tax. Cody, you are welcome to go mute or put something in the chat. Did that answer your question, or do you have more questions on that point?
Yeah, thanks, Brett. That makes sense. Okay. And I guess like when you're dipping into the principal, is it considered dipping into it based off of whatever the dollar amount is when the assets were sold, or when you set up the DST?
Good question. So what capital gains tax or even income tax rate are you taxed on when you receive it? Jake, you want to take that question?
So essentially, basically what you mentioned right there, how would it have been taxed had you not used the deferred sales trust? Putting it into the deferred sales trust and coming back out later on, that's how it continues to be taxed. And
however, it is based upon the year in which you receive it and the state in which you're residing, right? However, like if let's say you had a California property, the capital gains tax rate will follow you in California if you move to Nevada, right? And so they do track that, and they're owed that money because that's where you made the money, right? So that's the part where you want to work with your CPA depending on the asset type that you hold and where you reside and when you receive it. But you will be taxed in that state. Like we have a client, we sold an $8.3 million deal in Palo Alto. He moved to Henderson, Nevada, and he established residency there, and then started taking payments at that point. Now, he also has dipped into principal, and so he'll pay capital gains tax to California and to federal on that. So that at the new rates, so it's not the old rates, right? So that is potentially something you look at, right? You'd say, okay, capital gains tax rates are 20% federal, 13.3% state of California, 3.8% Obamacare tax, and then you have depreciation recapture. Biden is considering taking it from 20 to 26 or 28 on the federal level. And so on that, you have to say, well, is it going to be higher in this upcoming year? And how does that associate? Now, we think regardless, if you're $1 million net proceeds, $1 million gain, whether it's 30 to 50% or 37 to 57%, it's so big that it's really a moot point. You're still going to want to defer it. But does that answer the question or create more for you, Cody?
Yeah, that makes sense. In the case of cryptocurrency, is it based off of the state that you purchased it in, or the state that you sold it in, or both?
That's a great question. I'm not sure I really know the answer, but Jake, do you know?
Yeah, so I'm going to jump out there a little bit. And of course, there's not everything is cut and dry in taxes when we're discussing from federal level to state level, but crypto would be considered a digital asset. And of course, while you reside where you do reside, you're subject to that state law, right? However, it wasn't necessarily acquired based on your status of living in that state. I mean, if it were a piece of real estate, which is obviously geographically part of the state, or a piece of real estate while you lived in California, those are two different things and they're viewed a little bit differently. Now, crypto, which is not attached to ground anywhere, could be a different story altogether. And a lot of it has to do with time and how much time elapses. And you have different tax attorneys who will take a different position. And so the answer is kind of like as clear as the Coca-Cola, so to speak, right? I mean, if you look really hard, you can see through it. But the answer is, I mean, there are people who do get around digital assets, intellectual property, intangible things like that, who, essentially because they move to Puerto Rico, they move to a state that doesn't have state income tax, and they do things of that nature. And if enough time passes, they eventually have found ways and have been successful and have had court cases where it was allowed that they didn't have to owe back taxes on some of that blue sky, on some of those assets that weren't physically attached to that state. However, the same thing can be said about people who tried to get away from it and failed. All right. So the answer is pretty murky, I guess. But with crypto being a digital asset, I believe that you have a lot more strength and a lot more ability to maneuver something like that than somebody that would have a piece of real estate.
Yeah, and I'll add to that too. What we're doing with the Deferred Sales Trust is we're reporting to the IRS. We're saying, hey, we bought cryptocurrency for $100,000 and it's worth $25 million. Okay. And we've held it for 7 years. Here's our basis. Here it is. And the IRS, we believe, likes that, A, because we're reporting it, 2, because we're investing it, remember, for the income tax portion of it, that's going to be creating more jobs and they're going to get tax off of that. 3, our clients are taking payments, they're paying tax. 4, we're making fees, we're paying tax. So these are all really good things. It's also diversifying the income stream and or the tax stream, if you will, because it's not tied to such a volatile single marketplace. But all of those things are good things if you can report it, show it, and slowly pay it back. Like, to us, it's a win-win-win. So I'm gonna move on to the next question here in the chat, and it's talking about intellectual property. Okay, intellectual property, and the question is, can intellectual property can use a deferred sales trust to defer the capital gains tax on that? And the answer is yes. In fact, really anything that's subject to capital gains tax, U.S. capital gains tax, that is, right? Because this is the U.S. tax code. The deferred sales trust can defer tax on. The question then becomes, well, what's the minimum? Again, $1 million net proceeds, $1 million gain. So as long as it's big enough, then it makes sense, given the fees, given the constraints to close. So the answer is yes there. The next one was from Scott. With respect to your comparison, I think he was referring to the 1031 exchange. Wouldn't the Oz fund be the only option for BTC or business sales? That is the pro, and the con is more limited than the DST. Yeah, so let's talk about the difference between the deferred sales trust and opportunity zones, which I also did a video on. You can check that out on my YouTube channel, Capital Gains Tax Solutions. Check that out. So the answer is yes. One of the advantages of the opportunity zones is it works for the sale of crypto or businesses or real estate or a primary home. Same as the deferred sales trust. Remember, the 1031 only works for investment real estate. One of the pros also with the opportunity zones is at a certain point, some of those funds can be completely tax-free if you hold it long enough. And you still have some of that tax deferral for a certain amount of years. Some of the cons, though, are more so what I like to call the blockbuster way of exit planning, and that it's typically illiquid assets, it's typically out of your control, and it's typically very, very long term. So I like to say those are more for this like sleepy real estate money, unless you're the active GP doing the deal yourself and like, amazing, right? But if you're not like an expert in investment real estate, or you're not already developing and building deals for the last 10 or 15 years, right? Because most opportunity zone deals must be typically just ground up development, unless you're doing a complete rehab of a deal, which are very hard to find still right now. So I like opportunity zone funds if you can find a deal that makes sense. But if you're looking to be more entrepreneurial, the Netflix version of start your own business, invest in your own real estate, invest back into cryptocurrency, stocks, bonds, and mutual funds, have liquidity, have flexibility to go kind of control your own wealth plan versus giving it up to like even like a Delaware, for example. They're typically 7 to 10 year holds, right? So you're giving up all control and all the cash and all the liquidity, no diversification, to a company who's running it for you. And that's why I say it's like sleepy real estate money or sleepy wealth advisory, because you're just getting mailbox money, which for some people is great. Like you can do that, but most of what we're building is for entrepreneurial business, real estate owners, crypto owners who want to control their own destiny and have the flexibility to jump in and out of deals. Does that make sense, Scott? Any questions or thoughts there? If you're still here.
No, I'm still here. So thank you for delineating and distinguishing the differences between the two. My question was between an opportunity zone and the DST versus the 1031. I do think the 1031 is a lot more limiting than either of the other two options.
Yeah, for sure, right? 1031 can be very limiting, but it does give you the ability to control your own destiny, and that you're buying your own deal. And that's so, if you're selling a 20-unit apartment complex and you're buying a 40, and I'm going to go manage it, own it, add value, right? And I'm just going to keep building that. And that's great too. Not great for developers because it's not equal or greater value, and not great if it's a highly appreciated marketplace and you want some flexibility. Oh, also the opportunity zone too is cool because you only have to put the gain in, you don't have to put the basis in, right? Which is kind of unique versus the deferred sales trust and the 1031, the entire amount. If you want to maintain 100% tax deferral or as close to it as you can, the entire nest egg needs to go in there. Now you can also take boot and just pay tax on that. You don't have to put all of it in there. I've had clients close deals that are like $500,000 to come out, and then I want to put the rest of it in there, and you can do that. In fact, that leads to our next question. If someone is selling their personal residence and they have a $2 million gain, can they pocket the $500,000 that is allowed in the tax code as non-taxable gain, and the DST puts the $1.5 million in there? So the answer is yes, but I think what you're referring to is that $500,000 completely non-taxable, and the answer is no. In other words, what you're referring to is what's called the 121 exclusion, which if you live in your house 2 of the last 5 years and you're single, you get a $250 tax-free, or if you're married, $500. So for example, my wife and I, our first house we bought, $135,000 in Roseville, California, and we lived there for exactly 2 years, okay, as our primary residence. So, and we sold it. And we sold it for $250, right? And so all of that was tax-free because it fell within the $500,000 exclusion, okay? But imagine that property would have went to $2.5 million, okay? In that scenario, we still have that $500,000 exclusion, but we only get to take advantage of it in proportion to what we receive as a proportion to our basis and our gain. In other words, you can't have your cake and eat it too. You can't just say, okay, I'm going to take 500 here, all of it tax-free, and the rest of the 1.5 million is going to go in there tax deferred, right? It could be, I'll take 500, but you may only get 100,000 of that tax-free. You still have to pay tax on that 400. Now, does that mean you lose the other 400? No, you'll get that too if you take all 2 million. In other words, it's in proportion to your gain. Does that make sense, Andrew?
I think so.
Okay. And if you rewind that, you can do that again. So the answer is yes, but not all at once. That's the simple answer. Jake, any thoughts on that?
Oh, I think it was pretty clear and concise. It's exciting the fact that I just want to throw in that really this is a financial tool that's unique among others, meaning that oftentimes when somebody has a financial instrument or financial strategy, it's very delineated and can only do one thing, so to speak. And the Deferred Sales Trust, correct, it defers taxes, right? Which I guess if you were to say it does one thing, it does that. Or it defers the recognition of the transaction, or it distances the recognition of the transaction beyond that of the individuals who normally receive the funds. And it keeps them from getting contractual receipt, right? But with that being said, it's very customizable to the individual situation within those parameters, and provides a degree of flexibility that other strategies do not. I mean, we talk often about the timing limitations of the 1031. Or if we talk about a Delaware Statutory Trust fund or our opportunity zone, which, Brett, you've got some amazing videos on the comparison and differences of both of those strategies. In all reality, when it comes to timing, which sometimes is the most important thing to have control over when it comes to taxes, the Deferred Sales Trust truly provides an advantage there over several of these other mentioned strategies. And I think I'd just like to highlight that piece of information there, the control over when to take contractual receipt of that principal that gets rolled over, and how key and critical that has been for our clients, not just to initiate the process with the Deferred Sales Trust, but years later, like after they have it and after they use it, as they reinvest in another business, as they reinvest in other assets, how important and critical that is for their future distributions, and the ability, based on timing, based on whatever current legislation is for tax brackets and how assets are taxed, and what capital gains is taxed like in the future. It almost becomes a moot point what those rates go to and what the legislation changes to when you have control over when to take the contractual receipt of those funds at a future date.
Awesome. Very well said. We're going to open up for some last questions, and then we're going to wrap it up here. If anyone has any questions, you can unmute yourself. You can also type it in the chat. You can also go to capitalgainstaxsolutions.com, schedule a one-on-one consultation with myself or one of my team members. If your deal is $1 million net proceeds, $1 million gain. We're also kind of putting a stipulation too. We have so much business coming in. If for some reason you're closing within the next 30, 60 days, then go ahead and do that. If it's like, this is sometime maybe in the future, 90 days plus out, then you'll just come to this mastermind every Friday, totally free. Invite your CPA, bring everyone on. We'll all talk strategy here and make it very simple for you. So we do have Adam joining, and Adam, welcome. We've got a couple different Adams. Welcome. So we're just kind of wrapping everything up here. If anyone has any particular questions, you can type it in the chat or unmute yourself. Otherwise, I want Jake Miller to share where he can find him, and Pierce where you can find him. Pierce, why don't we start with you? Where can people find you if they want to reach out to you?
Yeah, so you guys can find me at kingdomluxuryrealty.com. I'm out here in Newport Beach, and I'll put the link in the chat, and also my cell phone number, 916-878-0903. And I'll put that in the chat as well. And you guys can reach me there.
Cool. How about you, Jake?
So alphamarktax.com, alphamark, A-L-P-H-A, marktax.com. There's a booking link right there, as well as the phone number, 1-800-773-1848. And happy to help out with your specific situations and let you know whether you're eligible first and foremost, and if it makes most sense compared to all the other strategies out there.
Thank you, Jake. Any other questions from anybody else? Scott or Jim or Andrew or any of the Adams, Rebecca, Gabriel, Carrie, Cody? Rebecca.
Brett, this is Jim Buchanan. I just put in the chat that could you please email us your contact information? I'm president of ASREX, Arizona Real Estate Exchangers, which is a an affiliate of the National Council of Exchangers. And we deal with many private money lenders, and 1031 problems cross my desk all the time. That's why you called me today. And so I'd like to have your contact information so I can pass it on. I'm a commercial broker in Tucson, and I don't personally run across it nearly as much as we do at the national level. So
thank you, Jim. The answer is
Thank
absolutely.
you.
I will send you information now, and thank you for joining. And we need more 1031 folks to join us, right? To join the fight,
Absolutely.
right? Because
Absolutely.
we want to align with exchange companies and educate them and help them understand it and them get comfortable with it, right? And so they can make an educated decision to offer this as a potential solution especially for failed 1031 exchanges. So that being said, that wraps up another episode or another mastermind here of the Deferred Sales Trust. We call it University Cryptocurrency Tax Deferral. Deferred Sales Trust made simple. And we just want to encourage you to invite more people to this. Come back next week again. It is going to be the holiday. I'm going to show up. I want to see how many people show up. I'm kind of curious on this thing. It's going to be there for Thanksgiving. I have a thought that people are going to be talking crypto and how high it's gone again. And they're like, how do I defer all the tax? And they'll be like, oh, there's that mastermind tomorrow. You can come on and you can learn about it. Wow, what a cool thing. Let's jump on. Let's push the button. And let's jump on. Let's get empowered. We say that an educated and motivated consumer or client makes better decisions. So we want to educate you. We also want to motivate you to take action, to do the heavy work, or we think it's easy work, but for some people it is heavy because you're learning part of the first time of getting to know us, bringing your CPA, doing the planning right now. So again, go to capitalgainstaxsolutions.com if you want to connect with me. Make sure you mention this when you do, and we will see everyone again next week. Thanks so much, everybody. Bye now.
That's right.
Hey, Brett, I'll send an email out to Jim for you.
Okay, sure. Thanks. Bye,
And
guys.
remember to eat the turkey. Don't be the turkey for Thanksgiving.
You can't